Good afternoon, everyone, and welcome to this session at Risk Minds, Developing an Investment Strategy to Meet Growing ESG Demands. My name is James Tufts. I'm a partner at EY, our global actuarial leader and UK consulting markets leader as well. I'm joined by a panel this afternoon that I will introduce in just a second. And just so they're all clear on the format, we'll open up with a couple of questions to the panel and obviously hear their responses. And then you will all see some capability to put some chat questions alongside your screen, hopefully. So if you have questions that you'd like to put to the panel, then please type them in and I will then be able to see them and put them to the panel. So with me this afternoon, I have four very distinguished figures from the insurance industry. Ferial Nadim, who is CRO at Utmost. Katia Pluto, who is EMEA CRO at Zurich Insurance Company. Eric Laserman, Head of Investment Management at Aegon in the Netherlands, and Mikey Eakin, CIO for Phoenix Group PLC in the UK. So welcome to the panel members, and thank you for joining us this afternoon. And hopefully everyone can hear me, and we'll be able to hear the panel in just a second when we talk to them. So I'm going to open up with a few questions to the panel, and the first one, Ferial, if I may, I'm going to put to you. So what risks do ESG commitments create for insurance company investment offices, particularly with respect to reaching net zero ambitions?
Okay. Thanks for the question. So I think some of the risks that companies face at the moment include making decisions where they're not really clear on fully understanding the impacts of making those decisions. An example would be, you're trying to get to a net zero ambition in the future, and you might make a decision to disinvest in certain asset classes or sectors, and that might be a decision you make because of pressure from stakeholders, such as regulators, maybe policyholders, boards, but not really fully understanding what the consequences of those disinvestments might be. You might want to see in the future that the investment into these sectors are necessary to help the whole economy move into a net zero position. But, the reason some of these decisions are made is because of the time frame that we're looking at. If we look in particular at like climate change, the E of the ESG, this is a quite a long time frame, as we know. And with that comes the quality of data to make some of those decisions isn't yet available, or it is sort of, there's differences in the data available. So I think over time that will improve, and those risks of making those decisions, an incorrect decision, will sort of reduce. One of the other factors is a reputational risks that you would sort of drive in an insurance company. There is a lot of things going on the ESG space, and companies are making quite a lot of bold statements, and that's good because that's sort of moving the sector, investment offices, insurance companies forward. But there's a risk that these statements at the moment are being made without fully understanding where the companies are at the moment. Again, if you look at net carbon ambitions that people are making, do they fully understand where their net carbon emissions are at the moment? So to make a sort of statement, you sort of run the risk that you'll make a statement where actually you might not be able to deliver in the timeframes you're making. So I think that will be another challenge that we'll find.
Yeah, no, thanks, Ferial. And just a couple of thoughts on what you were saying there. I think on the data point, I've got a couple of slides later that I'll show some findings from an EY survey around ESG, and data is by far the most dominant aspect that comes out as a challenge. I guess, though, very much the thinking is we can't wait till perfect data is out there. We just don't have that time span. So we have to make do with the data that's there. And certainly in terms of sort of fulfilling some of the actions that we need to do, the data and the trends and the movement of that should be enough. I think in terms of the more quantitative aspects, for example, where you allocate capital, I think the data gaps are more challenging. And just on your point around sort of activity and timescales again, obviously a lot of focus on 2050. But really, I think what we saw coming out of Glasgow, obviously, is big demands for organisations to think about all the interim steps in order to work up to whatever longer term goals that they have. And I'm sure we'll hear more about this afternoon. So thank you, Ferial, for opening up there. Katja, if I can come to you next then. So in your role, obviously you're CRO, but in your organization, maybe you can give us a flavor on whether you see ESG requirements or demands as a source of growth or more of a constraint. And, therefore, is ESG a differentiation factor or more of a hygiene factor now?
Thank you for the question. Well, first of all, I should say for any company, it can be either. Yeah, it can be either, and I believe actually it's a crucial, important strategic choice for any insurance. Yeah, either strategy can work in practice. You can consciously decide to be at the front of everything, which has its pros and its cons. Yeah, because being at the front means you will sometimes not be right because you are trial and erroring. You can consciously decide you want to be an early adopter. You can consciously decide to be a late mover. All of these strategies have pros and cons. Of course, the more you are at the front, the more you would naturally use your ESG strategy as a differentiator. And the more you can actually use it for growth, the more you want to be a late mover, you're probably on the other side. But here again, there is no right or wrong. It is a strategic choice. I would always recommend starting this strategic choice with the most important stakeholder there is, namely our customers. Understand your customers' needs, your customers' desires, and then build your strategic choice around that. Experience for us is that this strategic choice is even more important for parts of the investment portfolio where customers see more of what we are doing and where customers have also more choice of what they are doing themselves, i.e. unit-linked and pension, where it's probably more important than in traditional ones. Depending on the choice, couple of things from our experience, because we have consciously decided to be a leader and to use it for differentiation and growth. If you decide for that one, communication and transparency is crucial, and you cannot communicate too much. That is simply because in our stakeholder universe, we have very different and sometimes implicit expectations what people understand when they hear ESG. So while we cannot change these perceptions, we can at least be clear what we mean in each and every case, what we mean. Yeah, is it, for lack of a better word, a dark green fund, i.e. really kind of like the creme de la creme in terms of green investing, or is it a fund that might be more widespread but roots out the worst polluters, for lack of a better word? Both is valuable, both is appreciated by the customers, but it's not good if they confuse the two. So that's quite important. I would kind of said is where we can give choice to the customers that works better than just making the choice for them. This is again where unit-linked and other options are important. Again, as I just said, I mean, we have consciously decided to be a leader and use it as a differentiator. And we actually this year have seen it in growth. You will have seen we had our Q3 results last week. We have seen a tremendous growth, especially in unit-linked products, and that is just lovely to see. And a significant portion of the unit-linked growth actually comes from ESG propositions. So yeah, it works. Thank you.
Thank you, Kelly. And just coming back on one point, obviously, like Ferial, you are a CRO. So do you have now very clear ESG risk appetite statements within your risk framework in Zurich?
Yes, and I should say kind of this is not only for investment, this is everywhere. There are not only risk appetite statements, again, there are risk appetite and strategy statements. We have positions out on certain industries. We are very, very clear, very explicit about what we mean by ESG for different parts of the group. And as risk managers internally, we also spend a lot of time of thinking about unintended consequences. Ferial has mentioned some of them when it comes to reputation, when it comes to making promises that you might be sorry afterwards. But there are also others, like Ferial mentioned, about how do we work with companies? Do we want to use active influence, in which case you need to be involved and invested? Or do we actually at some point in time want to send a signal and say that's it? There are unintended consequences when it comes to transitioning the entire industry. Again, do you want to be a part of helping with the transitions, or do you want to be a part of forcing transition by divesting? And there are also increasingly, for me, considerations about where in the ESG space do we actually something that I would loosely describe as bubbles. Yeah. And could this, on the other hand, lead to unintended consequences for our customers as well? So huge topic. Risk appetite statements are out, but in all fairness, not really labeled as risk appetite statement, but labeled as strategy statements. And this is how it should be.
Great, thank you. Very helpful, Katja, thank you for that. So moving maybe over to the investment side. So maybe, Eric, if I come to you next, Head of Investment Management at Aegon. I mean, to what extent are insurance investment mandates and strategies being changed by the huge focus that we've had on ESG that I think we've all seen in the last 24 months has ramped up significantly? Well, what is that doing to the way that you are thinking about the strategy?
Well, James, thanks for the question. And before answering this question, I would like to look back a little bit and say that traditionally we focused on risk and return metrics, just simple volatility and expected returns, and optimize our portfolio according to those metrics. We started integrating ESG risks in our investment decision-making processes, or at the investment decision-making processes of our asset managers, the asset managers we selected, and we started using screening. Over the course of the years, the screening has led to more and more exclusions on our exclusion list. So the number of companies and issuers on the exclusion list has gone up quite significantly over the last couple of years, because we have set higher and higher standards for our investments. So if a company fails to meet our minimum standards, or if we see lack of progress on our engagement, then we can decide to exclude an issuer. We also started voting more and more often and on the shares we hold. And obviously, in the last couple of weeks, Aegon has made a pledge to enter the Net Zero Asset Owner Alliance, and we strive for the net zero to 2050. And within Aegon Netherlands, we've taken a step further. So we have set goals for the 21-25 year period. We want to reduce our CO2, and that will be reflected in our investment mandates. So the actual mandates are adjusted to incorporate these high-level goals, which are stated in the press release. In the run-up to this development, to this statement, we used one asset class as a pilot and set a higher standard up front before we publicly made these statements. And this pilot has helped us understand the way the asset manager is working, the way we can really put in the limits and standards in the mandates, and ensure that we are talking about the same level of positive impact in our mandates and level of exclusion in our mandates.
Thank you, Eric. Can I just come back on one thing that you sort of mentioned briefly and sort of went on from, but came out very strongly from Mark Carney in Glasgow a couple of weeks ago, which I suppose is supporting businesses as they transition to net zero. And so you were talking about certain sectors or businesses you wouldn't invest in, but I'm assuming that there was a huge role for insurance companies and other financial institutions to play in investing businesses in helping them make that transition. So in terms then of their sort of carbon footprint, it's not so much the absolute levels that you are challenging, it's more around the progress. Is that fair?
That is fair, but there are also certain sectors we have made statements about, and we don't believe will be part of the energy production in 2050. And those are coal and tar sands. And so we completely divest or will divest all our holdings in companies involved in these sectors before the end of the year. In addition to that, we also made a pledge to put 1 billion euros to work in the next 4 to 5 years in helping companies make that transition, the energy transition. So yes, it's both.
Yeah, no, thank you. Before I come to Michael, just to remind everyone that please do feel free to submit any questions via the Q&A box at the bottom left, or use the Q&A widget in the toolbar if you have any questions you'd like to ask to the panel. So Michael, I've known you from a long time, many years at Goldman Sachs, and you joined Phoenix a couple of years ago now, I guess, as Group CAO. Phoenix, for those of you that don't know, is, I'm sure I'm going to get the numbers wrong, Michael, but it's got several hundred billion under assets. So, you know, a lot of asset management is being done. I mean, how are you, Mike, thinking about the alignment between new and existing investments in ESG? And I suppose particularly thinking about investment that matching liability, so ALM, and strategic asset allocations, and having to feed all of the ESG thinking into that now.
Yeah, well, look, thanks, James. Thanks for that question, and thanks for the opportunity to participate in this illustrious panel on this really, really important topic. Look, as you said, you know, I'm the CIO of Phoenix. Phoenix is the UK's largest long-term savings and retirement provider. We manage just over £300 billion on behalf of 13 million policyholders. And for us, we're a purpose-driven organization, and our purpose is to provide our customers with a life of possibilities. And as we think about managing our customers' money in the run-up to retirement, and then in retirement, sustainability and decarbonization are absolutely at the core of our investment strategy. And I think if we take a step back, it's really interesting. You asked me, James, about strategic asset allocation. And if I look back on my career, you know, having been involved in many strategic asset allocations, historically, and probably up until about sort of 3 to 4 years ago, insurance companies set their strategic asset allocation by really focusing on return and risk and return, and then optimizing for an asset allocation that was in the confines of that insurance company's risk appetite. That's now changed. And as we think about our strategic asset allocation, we think about it not in two dimensionals, or the two-dimensional space of risk and return. We also think about it in a third dimension, which is sustainability and indeed impact. And that's really, really important for us and for our customers. And I think as we think about new and existing assets, what's key is that we factor into those asset decisions some of the commitments that we made. So last year on our Capital Markets Day, we made a commitment to be carbon net zero in our asset portfolio by 2050. When I relayed that to some individuals who are far younger than me, they were very quick to point out that actually by 2050, myself and the other management of Phoenix, as much as we love our jobs and love working at Phoenix, we're unlikely to be here. And so one of the things that we've done this year is to say for £250 billion of the assets that we manage, so 250 billion of that 300 billion, we're going to reduce the carbon intensity on that 250 billion by 50% by 2030. And for those individuals like me who are not carbon engineers or carbon economists, that's the equivalent of the carbon output of 6 million homes per annum in the UK. And so this really shows the impact that insurance sector on a global basis, but even here in Europe, can really have on the path to decarbonisation. Now, it's all well and good making those commitments, but I think it's a really important point that we anchor onto at Phoenix, and Katja mentioned it earlier, which is as we think about decarbonising portfolios, and as we think about integrating ESG into investment portfolios, we have to have the consumer outcome at its absolute core. And if we think about our client base, for individuals who may be in their 20s and 30s looking to save for retirement, actually their degrees of freedom on decarbonising the assets in their portfolio will be far greater than someone who perhaps is closer to retirement. And so embedding decarbonisation and ESG into investment portfolios cannot just be about grandiose statements that then feed top down into strategic asset allocations. It's absolutely imperative that they feed bottom up and that we match the lifestyle and choices of our customers. The final point I'd mention, because you mentioned matching adjustment assets, where we invest in a range of fixed income assets, some of them illiquid, to back our annuity liabilities. And again, there we can see real positive and material impacts that we can make in our asset allocations. Even if we look at some of the assets that we've invested in this year, we invested £80 million, or we lent £80 million to Nissan's car plant in Sunderland. Sunderland's in the northeast of the United Kingdom. It's one of the chronically underinvested areas in the United Kingdom. We're able to lend money to Nissan, so they could build electric vehicle manufacturing. And I really like that asset because we're investing on a regionally diversified manner in the UK, but the end produce is going to be electric vehicles, which have, as we all know, some really high sustainability characteristics.
Yeah, thank you, Michael. And you touched on, I guess, the S there a bit in ESG towards the end there, the societal aspect. I'd like to come back to that in just a second. But while the audience are maybe thinking of some questions for our panel, Anna, if you can just move on to 2 slides, please, for me. Thank you. So this slide just really reiterates what we've been discussing so far today in terms of, the importance of the agenda as ESG rises up to it and all the different aspects to it. I think, Michael, as you were talking about, the customer expectation side of this is huge and growing all of the time. And I think your point around grandiose statements rather than, not blah, 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 and actually having an action plan about how you get there and demonstrably demonstrating progress on that action plan is absolutely key. And if we just go on, Anna, again, skip the next slide, but maybe go to my last slide, if you may. So if you skip that one, that just shows some stats that I think we've largely talked about. But we at EY have done a survey recently around ESG investment strategy. And these are, areas of decision making that are challenging, but certainly, data quality came out massively at the top. And maybe I'll come back to the panel to ask a bit about that in a second. But obviously, with Aegon and Zurich represented here, European insurers with businesses all around the world, including obviously the US and the UK. Interested, Katja, in your perspective. I mean, do you see a different attitude within the different parts of your business in Europe versus, say, the UK? Well,
maybe because you also mentioned global. I mean, what we certainly see is that Europe consistently appears to be furthest ahead. I mean, you see this in the sheer size and volume of ESG funds. You see this also in statements that all firms in the financial sector put out or don't put out. Interestingly enough, for a global insurer like us, the big and significant wins are actually even stronger outside Europe, simply because there is so much catching up opportunity to do. Yeah. So from a global perspective, I see Europe ahead. Within Europe, I should say, I do not perceive a significant difference between continental Europe and the UK. In terms of the attitude towards ESG with regard to development of insurers. From an insurance perspective. What I do, however, see is, and this now becomes a bit of a micro level, I see slightly different perceptions and interests in part of our customer base, where I've perceived parts of continental Europe, especially on retail customers, slightly more engaged, at least in our data. Not necessarily saying that they care more, but they engage more on these topics. Yeah. Yeah, so that would be kind of my thing. So from an insurer perspective, not much difference in Europe by my perception, but a bit of a differential on the customer engagement side.
Interesting. Okay, thank you. Just changing tack very slightly, Ferial, you mentioned the lack of appropriate quality ESG data and how we sort of deal with that. And we talked a bit about how we can't wait until we have a perfect data set and we need to sort of, move forward at pace. Have you got any thoughts about, what we can do as a sector to help move that along the agenda?
I think it'll be a lot of sharing of knowledge. So you've got sort of our company Utmost, we're a small consolidator. So, we won't have the internal resources to be, having large teams where we can analyze data. So we're reliant on external vendors. And I think what we will find is more external vendors almost like rising to the top becomes sort of a standard where we can rely on it. I think we're finding at times like, are we all comparing like with like when we're looking at ESG data? And I think that will over time just improve as the data quality becomes and some sort of leaders come forwards for people like us who are going to, inevitably look at vendors to be looking at the data. On data, I think the other the thing will be around, so one of the things that we've been looking at is sort of scenario testing for the ESG bit, the E's, and what will our asset portfolio look like? And again, I think we're finding a bit of difficulty to understand which is the right vendor to use to help us to achieve some sort of analysis of our asset portfolio. We're sort of coming up with things, but it's not at a level yet where we're comfortable. And I think, again, it will just take a bit more time for the smaller sort of companies to get there.
Yeah, I mean, I think, as you say, particularly for the smaller organizations, sharing of industry sector data, public data is going to be absolutely key. And I think there is a lot of that going on. I know there are quite a few bodies out there that are helping with that, and that has to be the way forward. Eric, if I can come to you next. I mean, I think one of the challenges that we face, and it was on my slide actually, that was from the EY survey, was the definition of ESG or sustainable is pretty broad, right? I mean, it's not a well understood definition in terms of the exact boundaries. And obviously, there's always the worry of that very commonly used term now, greenwashing, as part of investments. I mean, how do you ensure as an investment manager that you're sort of managing against that?
Do you mean how do we prevent being accused from greenwashing? Is that the question you're raising?
Or I suppose, taking an asset on and putting it into the Aegon portfolio that actually isn't, taking it on the premise that it is a green asset or an ESG-friendly asset, and actually it's not as green as it seems.
Okay, thanks. I understand the question, and my answer is that there is a responsible investment committee, and which goes over the investment proposals presented by the analysts. So the analyst will have to state how a company or an issuer contributes to the E, the S, and the G, and why the analyst thinks it's a good idea to include the issuer in the portfolio. And that proposal is discussed and evaluated by ESG specialists. So those are separate from the investment teams and have no other reason to reject or approve a issuer based on the merits of the project or the issuer. So it's the second step in the approval process to ensure that an issuer or an investment meets our standards.
Yeah, no, thank you. I mean, Mike, I guess similar question to you about what more could asset owners and managers do to support, what Eric was talking about in terms of this investment screening.
Yeah, absolutely. Look, it's a really key area of focus, and certainly for us at Phoenix, the way we approach this is really proactive quality dialogue with the companies that we invest in, either our shareholders invest in or our policyholders invest in. And we really believe that progress to a decarbonized world is only going to happen with that bottom-up investor to investee dialogue, where you have real-time dialogue explaining to the companies that you invest in your aspirations as a long-term investor, and really understanding how they're going to execute on their path to decarbonization. Now, we fundamentally believe that this can only really happen by proactive engagement. So we really believe in engagement. And to that end, we've invested significantly in this. We recently hired a head of stewardship, a dedicated head of stewardship that sits within Phoenix Asset Management, Valeria Piani. And Valeria's job is to make sure that we are doing, as an asset owner, on behalf of that over 300 billion pounds of assets that we look after on behalf of our 13 million policyholders, that we have that proactive engagement. Because it's very easy for us all to come up with assets that we would not invest in, such as, I think coal was mentioned earlier. But there's some companies out there that have so-called got these brown assets on their balance sheet. And our view is it would be a bit cumbersome or clumsy just to simply divest of those companies. Really, what we need to be doing is having dialogues with those companies, understanding how they're transitioning their business over the next years and decades to a decarbonized world. We would say, though, and whilst we really believe in engagement, the ultimate sanction that we as investors do have and will execute if we do not believe companies or sectors are really on the path to decarbonization is divestment. Now, underpinning all of that, again, it comes back to customer outcomes and what is the best customer outcomes. What do our customers want? And I think certainly when we speak to our customers, many of them already believe that their investments are in substantially decarbonized assets or sectors. Whereas, if you look at some of the major developed market equity indices, some of those equity indices in terms of global warming are way above 1.5. So it can be at like 3 and 4%. And so, it needs proactive engagement with the companies we invest in, and then it needs engagement with the customers, so we really understand their desires, because ultimately it's their money that we're managing on their behalf over the long term.
Yeah, thanks, Michael. And sort of related question has come in from the audience, in that can institutional investors, investment organizations like yourselves, I guess, do more to encourage nature-based solutions? And I'm thinking that these are ecosystems that help cities become greener and better places to live, and all of some of those things that you've touched on. And I guess they're not perhaps their normal route that in the past you would have invested in. But is there a route and a role for the likes of Phoenix and Aegon and Zurich, etc., utmost to play in that?
Yeah, look, I'll take that firstly, maybe from Phoenix's perspective. We absolutely take the view that as a long-term investor, as a very long-term investor over time, it's absolutely incumbent on us to invest, and indeed in some cases provide some of the early stage capital that's required for technological advances that will take us away from a carbon intensive economy to a decarbonized economy. And we really see that early stage investment in twofold. You asked specifically on nature-based strategies. We absolutely believe in that. I mean, I think there's now a range of proposals for actually restoring peat bogs in Scotland and in Ireland as a means of actually replenishing the ecosystem so that carbon can be absorbed. We absolutely believe in that. The nature of those investments are really at the early stage, and given the approach that we take to investing our customers' money over the long term, we absolutely would consider investing in that. Other areas is around clean energy, so the production of clean hydrogen, again, which requires significant investment to get the technology to a space where we can produce clean hydrogen on a scalable basis, or indeed carbon capture. So I think where we need to deploy our investment firepower, but again, with the customer outcome at its core, is in technology that helps us accelerate away from a carbon-intensive economy. Nature-based solutions definitely have a role to play there, and also the technology that's required for clean energy. And I think both of those are required. But great question on nature-based solutions, and yeah, we'd absolutely welcome that.
Yeah, and also to chip in.
Please.
Mike has stolen most of my words. Also, but thinking through from a global and long-term investor as Zurich, I mean, these nature-based solutions, especially when it comes they are very often infrastructure related in some shape or form. Yeah, and infrastructure are long-term investments, so they naturally fit insurance balance sheets with long-term liabilities. And as an insurance sector, we can and should do more. I also agree with Mike that some of these solutions are in early technology spaces. So there is a certain amount of due diligence that has to happen, and this does happen. One thing I should say, I cannot now resist to say, is that I'm also, over and above Zurich, I'm also a non-executive director at the European Investment Bank, which is the development bank of the European Union in Luxembourg. I'm a member of their audit committee. And what they are doing is effectively, it's to a very, very significant amount in exactly that space. Yeah, so it's a bank. They also have equity holdings. They invest in venture capital. They invest in early stages technology to exactly foster that transition. I mean, for example, we recently financed a floating wind farm. So a floating wind farm, it bubbles with the water off the coast of Portugal, because this is where everything else would not make it feasible from a structural perspective. Why do I make this small detour? I think what a currently underappreciated solution is indeed going into these early stages of investments with partners. Again, be it partners like multinational development banks, be it partners like other public-private relationships, be it partners like grants from the European Commission or whoever it is, to combine the insurance sector's firepower when it comes to investments and financials with very specific technology knowledge that these institutions might have that we might not have. And this is a really winning combination. This is why I talk so much about this. So these partnerships with institutions like this, for me, are the future. Yeah. And again, we have the long-term firepower as a sector. So why not? Thank you.
Thank you, Katja. No, that was a great interjection. And I want to come back actually, because I think in a second, I want to ask Ferial a question first, but you make the point around the very different sort of types of investment opportunities in ESG, from sort of startups to very mature organizations. And, I think there are some interesting decisions that the investment teams need to make. But Ferial, if I may, I wanted to come to you. ESG, we've talked mainly on the call today about the E in ESG, and I just wondered if you had any thoughts about the best way of incorporating S and G into the strategy, and actually, is there sometimes a conflict between those three?
Yeah, I mean, I'm going to be honest with you. I think we find ourselves talking just generally, especially in some insurance, more around the E than we do of the S and the G, and maybe it's because of the financial nature. I can see more and more of the S and the G coming to the forefront, and maybe in insurance, for example, some sectors like Lloyd's market might be ahead than, say, life and pensions. But I think the way that we can do more on the S and the G is sort of keep top for a company like ours, again, small. What I'm finding is being part of lots of the forums where you have the CROs and we're talking about the risks. We're going to talk more about the S and the G. There's also, from an employer perspective, you've got your employees pushing you more on what are you doing around the S and the G. And again, we'll go back to the customers. I think you'll find pressures from customers coming through on the S and the G, specifically on the S, what are you doing? And finally, another stakeholder will be the regulator. I think we're seeing a lot more on the regulator sort of horizon. I'm talking on the sort of societal impacts, diversity, inclusion. There's quite a lot going on. So I think there's quite a lot of pressures coming from all senses, which I think the E bit has probably been spoken about a lot more in the last 24 months, but I could definitely see the S and the G sort of coming up at the same time in the sort of coming months and years.
Yeah, I mean, I think we've all seen, haven't we, probably on the back of various global situations, including the pandemic, but obviously some other situations that have occurred in the last 24 months. All around the world, actually. I'm trying not to single out the US, but I think a lot of things have come from there that mean that the S and the G are really becoming, massive focal agendas for society and therefore for financial services. So I would agree very well. That's only going to continue on that ramp up. Eric, if I can come to you next. I don't know if you were lucky enough to go to Glasgow at all in the last couple of weeks. Obviously, it finished on Saturday, but I'm sure, given that your Aegon UK headquarters is only sort of 30 miles or so away, I'm sure Aegon were there in some form. I mean, do you have any key takeaways from what came out of Glasgow, and any announcements, any of the interesting announcements that would affect ESG investment frameworks? Obviously, the big one, I guess, one of the big ones is that listed companies, including financial institutions, will be required to prepare net zero transition plans by the end of the next year, which for all of us who work in insurance and financial reporting, that time will come around incredibly quickly. So, Eric, any sort of thoughts around COP?
Yeah, so for us, the first step we've already taken at Aegon Netherlands. So the first step in our path to net zero. I personally haven't thought about the next step, the next 5 years, the 25 to 2030. We know where we want to be at 2030. We know where we want to be at 2050. But the actual investments we're going to make and actual changes we're going to make in our investments, either through engagement or through exclusions, that still needs to be panned out. What I wanted to comment on just before you ask the question is the way we try to incorporate the S and the G in our investments. We actually do quite a lot on the S. S in social, financing, low income rental homes, social housing loans, actually provide mortgages to people who cannot afford a mortgage without a government guarantee attached to it. So there is an option for those borrowers to borrow money and buy their own home. And that is across various asset classes and across various jurisdictions as well.
Yeah, thank you. I mean, I think from my point of view, I'm just trying to find my notes, what I made on COP 2026, but there were three big takeaways for me, and unfortunately I can't find my notes, but I think one was around 2050, but absolutely the need to have much more short-term plans demonstrating those transparency and the evidencing of that. I think the other was the engagement around the whole group of stakeholders that all organizations deal with, and obviously customers we've talked about quite a few times, but then you've got the regulators, staff, etc. A huge lot of engagement and interest from all of those. And I guess the other point is around the data point keeps coming out as well, and how we deal with that. I mean, Michael, I don't know if you were in Glasgow, but again, I'm sure Phoenix were represented there. Have there been any sort of fairly instant impacts or knock-on impacts to the way that you think about things?
Yeah, so I was actually fortunate enough to be part of the Phoenix delegation to go up to Glasgow a couple of weeks ago, where we participated in various panel discussions. And I got the opportunity to reacquaint myself with your colleague, James O'Malley, which was great. But I'd say, look, from our perspective, there's probably, I would say, three key takeaways from COP26. One was just the presence the quantum and quality of the presence from the financial sector, not just the insurance companies, not just asset managers, not just the professional services firms like EY, or but also banks as well. And that was really great to see, because as discussed earlier, we really do have a pivotal role to play in the decarbonisation. I think the second thing I would say is there was a tremendous amount of excitement about actually just getting on and really trying to progress on plans to decarbonise economies over the next years and decades. The third thing I would say is, there's a real, and you wouldn't expect this necessarily from people from financial services, because we choose career in financial services. Most of us actually believe in free access to capital markets with limited government intervention. But I think that the scale of the challenge on decarbonising economies over the next years and decades is so monumental that it cannot just be done by the consumer and the private sector. It does need support from governments. And specifically, governments need to step in, and they need to incentivize investment in companies and incentivize sectors who do really try and accelerate that decarbonisation journey. And they need to also penalize those companies and sectors that don't. And that's a really, really difficult balancing act for governments on a global basis to achieve. But it really does need that. But we do think there's small things that policymakers and governments can do. And one of the things they could do in terms of building green technology and green infrastructure is, we love investing in infrastructure, but we really like investing in the debt part of the capital structure of infrastructure. Investing in infrastructure where there's a development or a construction or a research and development phase doesn't really fit our liabilities. And that makes it tricky for us to get involved in that early stage. But to the extent that governments could come in and provide wraps or guarantees on that early, some part of the capital structure and the cash flows would be really, really impactful. And that would be, from a Phoenix perspective, that is our call to policymakers to really help, to incentivize the path to decarbonisation. I said there were 3 points. Sorry, there's fourth one. The fourth and final point, as you know, James, having worked with me many years ago, I'm not that good at counting. So there's 4 points. The fourth point I'd make is there's a lot of focus right now on public companies and PLCs. We've got the whole TCFD, and absolutely all of that is absolutely appropriate, so that investors can make the appropriate decisions as to the assets that they invest in. I think there's one point which came out of COP, which is we also need to make sure that the disclosure requirements, the incentives, the disincentives that apply to publicly listed companies also apply in the private sector. We are not going to get to a carbon net zero world if it's just certain segments of the economy that are driving it. And the final thing I'd say is, in order to make this, to really have an impact on decarbonisation, the technology really needs to be there, and it needs to be scalable, so that technology developed in developed market economies, like in Europe, like in the UK, like in the US, can then be exported on a scalable and economic basis to developing market economies. Because there's no way we're going to achieve our targets on global warming unless we have scalable solutions that developed market economies can benefit from, but also developing economies as well.
Yeah, thanks, Mike. I think we all know if you ask an actuary to give you 3 points, we'll get anywhere between 0 and 10. So no surprises there. But no, you make a very good point around, and I touched on it earlier, sort of startups versus sort of more established infrastructure, and that sort of debt and equity, trade-off, and therefore the attractiveness of those asset types or asset classification types to insurance companies. And yes, I mean, your thought around sort of governmental support and backing there is a very good one. Maybe, Caddy, if I can come to you again. I think you talked about how insurers can be effective stewards for their investments, but then you're obviously going to have exclusion policies. And I think you've all mentioned this around certain sectors. Oil and gas might be obvious ones, but obviously sort of weapons might be another one. How should they go about trying to balance sort of active stewardship of assets versus exclusion assets? I mean, how do you do that within Zurich Group?
I think the long and short is what I think kind of Eric explained beforehand, namely, well, to put it not too subtly, engagement is always preferred where we have a significant chance of engagement making our investments in these firms greener. And this is where engagement is the first choice and where you need to have divestment, again, as the ultimate action, just to show that you're serious. There might be other sub-subsectors, and I really say sub-subsectors because I don't think entirety of oil and gas belongs to that one, or indeed kind of larger sectors where, again, to put it bluntly, where thinking about an ESG transition is just very hard to imagine. Cluster bombs. I mean, anyone telling me how do I get a cluster bomb producer to comply with ESG, help me understand that, and we will start engaging. But there might be in the very individual sub-sectors where firms might take the stance to say, you know what, we find transition by the sheer fact of where the sector is playing too hard to imagine. So what else to do? I mean, what would be the target of engaging? And I think kind of the subtle difference and the wisdom lies in telling one apart from the other and then acting accordingly.
Yeah, no, that all makes total sense. Yeah, I think cluster bombs would be a hard one to get into any of these investment portfolios. Very hard to greenwash. But just on a more serious note, Feria, if I can come back to you, we talked a bit about S&G, and obviously one of the things, conscious of this, and by the way, to everyone listening, we've only got 6 or 7 minutes left, so if there are any questions, then to do again, please put them in the chat. S&G is becoming, as we said, very important. D&I is obviously a subset of that, very important subset of that. One of my roles at EY is the financial services D&I partner sponsor. And I just wondered, Ferial, if you had thoughts around targets. So often these days we see that boards have targets around representation, either from a gender or ethnicity point of view, and whether you thought that was the right way to go, or what is your thinking around that? And therefore, equally, from an investment point of view, whether that would form part of the criteria for investing or not in an asset.
Yeah, okay. It's quite, I think this area is actually quite difficult because I think there's a lot of multi sort of dimensional levels to it. I can understand why you've got some sort of guidance coming through around certain representation of females, for example, on your boards. I can see where it's come from and what it's trying to achieve, but I think this is quite a complicated and actually much longer time horizon thing to achieve. So you'll see that some industries are talking about almost starting at the graduate level, where do we need to do something there so that you can build up almost the pipeline and succession plans to get people at more senior roles. My personal view, there's just it's not an easy thing that is quick to solve. Is it right that we should just have X% females on boards? Especially when you've got middle managers where you might have a higher representation, say, of females, but why isn't that translating onto the top level? So there are questions to be asked there, but I don't think it's something that can just happen overnight and quickly. Again, you've got to start looking right at the sort of the ages where there's graduates coming out of universities where they might be multi-skilled in different careers. How are they progressing up the ladder? What's also preventing females, for example, going to the top? There's loads of questions that need to be answered, and I don't think it's I personally don't think it's as easy as just saying you should have an X percentage at the top. I can see what it's trying to achieve, and that's great, but it's a much deeper conversation that needs to be had about what's happening to the whole succession and the pipeline of people that are, and females and multicultural going up the levels. So I think it's quite a deep conversation, but it's good that it's happening and people are aware of it. So that's a very great step forward.
Yeah, I mean, I would agree. I think the disruptive. Go on, Katia, is that?
Just to chip in here, actually, Ferial, I wholeheartedly agree with you. Proper D&I takes time, and it takes time and a lot of devotion to understand what prevents D&I from developing naturally, because then it's about tackling these blockages more than a numbers game. Having said this, again, this is our personal opinion, not a Zurich opinion. I quite like the quotas in the meantime because they're putting the spotlight on things. I do not see them as a means per se, but they can help as a temporary measure. So, okay, personal opinion. But coming back to the blockers, we have recently kind of done quite some work in actually trying to understand the importance of the I dimension. Because whenever we talk about quotas, whenever we talk public, whenever I hear public talk about D&I, it tends to be 80% on the D. Yeah, I'm halfway through coming to the conclusion that the real turning point and the real winning point will be the I. And just for anyone on this talk who seems slightly confused by this distinction, D for me is if you come from a gender minority or ethnic minority or whatever minority point, if you're getting invited to the party. I is if actually someone asks you to dance and you don't sit in a corner all on your own. Yeah? And I believe there is a little bit too little focus on the I. And the I might be one of the keys to get the D up.
Thank you, Katia. I mean, I think the disruptive voice element of all of this has certainly, again, been very helpful in the last couple of years. I think, very early on your point around targets, I think targets are only one element of sort of almost a measurement element, and I think they're helpful for the measurement element, but clearly that is all that they are really, and sometimes they can be a North Star, a sort of goal, a sort of vision as well, but obviously all the things you're saying about really unpicking why it is hard or what is going wrong and how you address that is the key. I'm super conscious of everyone's time and I want to be respectful of it, so I want to finish bang on the hour. We've got about 2.5 minutes left. So Eric, I'm going to ask you, give me one thing that you are excited about in terms of ESG and very positive about for the future to leave us on a high, and I'm going to have one other question if you're quite short on answering that after that.
Well, I'm on a high because I'm pretty sure that we as a sector can achieve the goals we've set for ourselves. And I've seen so much improvement over the last couple of years that if you even linear extrapolate that, it's going in the right direction, certainly. And there is much more to come. So I'm confident that we will meet our targets.
Well, that is a very good comment and does leave us on a nice high. It leaves a bit of space time. So Feriel, would you agree with that? Anything to add?
Yeah, I would. I think even just as 2 years ago, I think I went into a board meeting and we talked about climate change. And somebody made a flippant remark about, we won't be using plastic straws. I can see the massive change over the last 2 years from actually being a bit of a tongue-in-cheek comment to action being taken, people taking this seriously. So I'd agree with Eric that, I think there's been massive progression, but it's making sure that continues and it exponentially continues over the coming years. But I think the fact that we're all talking about it so much, and you've had COP26, which again has left people on a bit of a high, I think you sort of set the standard that it can actually progress quite quickly and well.
Absolutely. So engagement. Michael?
I think it's incredibly exciting. You think about previous generations of people who went before us in financial services. They had to deal with high inflation in the 70s and 80s, and the sort of tech bubble in the late 90s and the early noughties, and then the global financial crisis. What we've got to deal with here, and the foundations that we lay over the coming years, will be people will reap the benefits or not, as the case may be, in years and decades to come. So I think this generation of people involved in financial services can arguably have the most impact, and that's what excites me the most about my job.
Thank you. That is, again, a very exciting way to end. So thank you to all of those, to all four of you on the panel, Katia, Feriel, Eric and Mike. Thank you to everyone who has joined this call this afternoon. And I'm sure there is, like all of these events, there's some sort of feedback form, which I'm sure Risk Minds would like you to complete. So I'm going to sign off now. Goodbye and have a good rest of your day, wherever you're calling in from.